So what is the BIS so worried about?
Well, you know, as soon as I saw the report, and I not only saw ETFs, but bond ETFs, it certainly piqued my interest. So a lot of this has to do with how these passive bond, the indexes that they track, how they're set up. So they're a lot like equities. We see a lot of equity indexes market cap based. So on the bond side, basically, the more outstanding debt you have, the bigger weighting the issuer is going to have in the index.
So you suck more in? Yeah.
Exactly. So what BIS is arguing is that this sets up this incentive structure that's not very healthy for the market. If you're an issuer, you're going to get rewarded if you have more outstanding debt, if you take on more leverage. So the argument is that as passive becomes bigger, issuers see that they can be rewarded by taking on more leverage, and it's going to encourage more leverage in the system when we already have a massing amount of corporate leverage in the globe right now. So they're pointing this out as something to definitely keep an eye on, especially as we definitely do see the flows moving toward passive bond ETFs and funds.
Is this a QE story?
Partially. So, I mean, come on, when you think about outstanding debt and why there's a lot of leverage, it's because it's been cheap to do so. It's hard to make the argument that it's for any other reason than ultra low interest rates. So if we see that coming down, maybe then we can start to make an argument of what impact the passive bond funds are having right now. But it is nearly impossible to tell with those ultra low interest rates.
You brought a chart, Dani. I'm pulling it up right now. It is 66.53. Talk us through what we're looking at here. Fixed income flow show.
Yeah. The flow show, exactly. So it's quite remarkable, the flip to passive funds. So in white there, you see the flows into passive ETFs and mutual funds. This is from Bloomberg Intelligence, who highly recommend checking out their research on the flows. They've done a great job of tracking this. So you can see that passive has gotten very popular. We've had a couple years where active has outflows, but the one consistency there are traders moving towards bond ETFs. And we've heard frequently a lot of investors complaining about the structure that BIS is pointing out. Unlike in equities where it makes sense that maybe you want to take on companies with larger market cap of tracking the market that way, perhaps it doesn't make too much sense that you'd want the most indebted companies in a bond index. So we definitely have seen issuers talking about tracking different indices, building different indices that are somewhat more smart beta. But for now, the majority definitely is going into these funds that track bonds that have the largest issuance.